Hello, everyone. My name is Fred Kaplan. I'm here to speak to you today on Fallacies and Fairytales, the truth behind business valuations. I'm a partner at Stony Hill Advisors. We are lower middle market mergers and acquisitions intermediaries, and I am a certified M&A professional. I'm going to turn over now to my colleague and our CEO, Paul Visocki.
Hello, everybody. Fred, you want to put the agenda up, or the first slide, I mean? There we go. Sorry for that delay. So I founded Stony Hill Advisors in 2010. We are an M&A advisory firm focused on both buy-side and sell-side transactions, along with business valuations and a service we call exit value planning. And that name connotes doing exit planning coaching, but building value while doing so. We focus on the value component of getting a business ready for the next owner. And the value is directly related to the risk factors. And Fred will talk more about the value drivers that are identifiable in any business. And those are things that we coach to improve. Our business focus as an entity is on the lower middle market size businesses. And our primary definition is that most of our effort is at finding companies to help in the 5 million to 30 million revenue range. But the lower middle market and this is a generic definition, but it'll span from 1 million to 50 million in revenue. These are small businesses owned and operated primarily by the founder, and many of them, and the focus of our business is the baby boomer generation business owners who will need to sell their business in most cases to afford retirement. And that gets back to the exit value planning. Our goal is to help any business owner retire at maximum wealth obtained from the business. We are a portfolio company of small business development group firm, a publicly traded firm, and this firm is making other acquisitions, mostly in the western half of the U.S. And the goal is to take the entity to the public markets in the future. But for now, they're funding our growth. We're continuing to grow. We have 10 partners now, and they are scattered from Connecticut. So I'm in Connecticut, but I have another partner in Connecticut, Long Island, and New York, New Jersey, Philadelphia, Eastern Pennsylvania, Allentown, Bethlehem territory, Pittsburgh, Dayton, Ohio, Nashville, Tennessee, and hopefully we're looking to bring on somebody in the Maryland territory in the near future. So we're growing throughout the eastern part of the U.S. Our focus is helping businesses in these territories in the coaching process on a personal level, because we recommend that an exit is a process, it's not an event, and it can take 3 to 5 years to get a business ready at maximum value. So we have people in local markets to allow for that process to go on over that period of time. But we do have clients nationwide. In a transaction, it can be done very remotely, but it's better to have the local coverage like we do have. So we span that based on since the pandemic, we've grown through the use of remote technologies like this presentation on Zoom. So that's a little bit about us. I'll let Fred take it from here.
Thank you, Paul. What I'd like to do today is talk really about 5 different subtopics. We'll go over valuation terminology, make sure we're on the same page regarding that. Talk about a number of myths. These are things that you may hear from other professionals, even your neighbors, and we want to help dispel those. We'll go over the methodologies that are used by valuation professionals, discuss the actual process of performing a valuation, and finish with a discussion of what are some of the key value drivers. What are the elements and characteristics of a business that drive value beyond just better profits? We know that a higher company with higher profitability is going to be worth more than one with lesser profits. But there are many other aspects of a business, certainly involving risk, that we'll go over, that are used by professional valuation advisors to determine your value. And so when you know what the inputs are, hopefully you can manage them to your own success. So let's talk about the definitions. MVIC, or market value of invested capital, really is the selling price. Net sales, obvious. Gross profit, also obvious, although as a professional valuation advisor, I do have to drill down because some companies will include direct labor in their gross profit. Others will use it and put all below the line in your SG&A, selling general administrative expenses. So we have to be careful about that when we're doing our calculations. EBITDA, the term you probably know, earnings before interest, taxes, depreciation, and amortization. So we're really looking at cash flow from operations. And then SDE, may be a new term to you. This is where we add back owner compensation and related benefits to EBITDA, creating the seller discretionary earnings, or SDE figure. And this is done because the owner of a privately held company has discretion over whether to leave profit to reinvest in the company or take it as compensation. The SDE represents the free cash flow that a buyer would receive, with discretion to spend on compensation or reinvestment in the business. So a little note about EBITDA and SDE. I prefer to use SDE over EBITDA in valuation calculations because EBITDA is fungible. It can be manipulated. The more owner compensation, the lower the EBITDA. But the free cash flow generated by the business is the same. One owner may choose to take more comp, lowering EBITDA, while another leaves the cash in the business, raising EBITDA. But the business generates the same amount of cash from operations. You'll see this in a minute. Here, let's look at Company A. Sales of 100 less cost of goods sold equals gross profit of 60, less operating expenses of 40 gives us 20 units of net income. We add back 10 for the interest, taxes, depreciation, and amortization, and we get an EBITDA of 30. But note that within the operating expense, there are 10 units of owner compensation. So we're going to add those 10 units back to EBITDA. And so our EBITDA of 30 becomes SDE of 40. In Company B, we have the same sales, cost of goods sold, and gross profit, but in this case, higher operating expenses of 50, which leaves us with a smaller net income of 10. The add back for EBITDA is the same, so we have an EBITDA of 20 in Company B compared to 30 in Company A. However, the owner comp in this case is 20 units, not 10 units. We add back the 20 units of owner benefits to EBITDA, we come up with an SDE of 40. So here's an example where in Company B, the owner is taking more comp, 20 units, leading to a total of 50 units of operating expense. So that lowers the EBITDA. But once you add that back, it's really 40 units of seller discretionary earnings, same as in Company A. In other words, the free cash flow that the seller has discretion over how to spend is the same for both businesses, even though their EBITDA is different. Here are a few of the other adjustments that we'll make to calculate seller discretionary earnings. One-time fees and expenses. We see this often in terms of insurance recoveries or maybe a lawsuit. So these are expenses or revenue in one particular year, but they're not indicative of the history of the business, nor really relevant to projections of future cash flow. So while they're in the profit and loss statement for the current year, we're going to add them back. Any rent above or below fair market value. This often happens if the business owner also owns the real estate and rents that property to the business. We'll make those adjustments. Sometimes they're redundant assets. A business may own a mountain home that they use periodically for meetings, but it's really a minor part of business. It's not necessary to operate the business. So we'll make adjustments for those expenses. Repairs and maintenance is another one where companies will maybe be too aggressive in expensing the repair and maintenance costs instead of capitalizing them. Maybe they're buying excess inventory toward the end of the year. They want to do that for tax purposes because they're a cash basis taxpayer. But those expenses are really not reflective of the month-to-month operations of the business, not appropriate for the valuation. And so we will add them back to SDE before doing our valuation calculations. So which multiple matters most? Well, the answer is it depends and may depend on the buyer. Financial buyers are often purchasing a future stream of profits. So they're focused on EBITDA and SDE. Financial buyer often not only owning, but operating the business. I pay 4 times SDE for a business. I have to wait 4 years before I begin receiving a net return on my investment. If I'm a strategic buyer, like a competing company, I already have the infrastructure to operate the business. So I'm purchasing to run the company inside my existing ecosystem. Since I don't need to acquire the SG&A functions, I'm focused on gross profit, and I'm willing to pay more since the incremental gross profit will drop mostly to my bottom line. Now, if I'm an institutional buyer like private equity, I'm focused on sales. I'll bundle several companies and slash operating costs of the acquisitions because my portfolio of companies can operate more efficiently than a single company. I'm willing to pay more because I will benefit from economies of scale. Number 2 on the agenda is dispelling valuation myths. The first myth is that businesses can be valued by applying rules of thumb. Rules of thumb are metrics designed to broadly estimate a sale price, such as price equals 1 times sales or price equals 4 times EBITDA. While rules of thumb are sometimes used by valuators as a sanity check after evaluating a business via other means, it's wrong to use a rule of thumb as the primary method of determining value. Rules of thumb assume an average company in a specific industry at an average size, but every closely held business is not really average. I'll show you why. In this slide, the top chart shows enterprise value over EBITDA. And you can see that they have stayed in a kind of a range between, well, we have an 11.1 low in the first quarter of 2020, but that was pandemic effect, mostly sort of in the high 12, 12.7, up to 15, 16. And the last few quarters have been around in the 13x enterprise value over EBITDA. In the bottom graph, we can see that the enterprise value over revenue also kind of trades in the same band, 2.3 times to 3.2 times revenue. So one of the reasons why rules of thumb based on multiples of sales revenue are really not reliable is because of different profitability. Think of two companies with similar sales, but with different levels of profits. Clearly, they should have different values. Let's look at privately held companies. This chart shows that selling prices as a multiple of EBITDA across all industries have been trending downward over the last 6 years. However, there's been a rebound since the third quarter of 2022, but that was really temporary. With an economic downturn on the 2023 horizon of whatever depth and duration, we expect valuations to continue the decline seen in the last 2 quarters. This chart shows selling prices as a multiple of net sales revenue. And it shows a little bit of a different trend. After falling from 2017 to 2020, they rose considerably, taking a big leap in the third quarter of 2022. However, in the last 2 quarters, multiples of selling price to net sales fell back near the levels of the prior 5 years. With the macroeconomic headwinds of rising inflation, higher interest rates, and the war in Europe all still in play, it's no surprise that the hiccup multiples of third quarter 2022 fell back to earth. The next myth I'd like to talk about is that valuations use the same multiples for similar businesses, and it's just not true. For a fair business valuation, one needs a deep understanding of the business and needs to consider all the company's financial and technical aspects. The company's brand, expected growth rate, business model, customer base, and other factors significantly determine business value. Since all these factors will differ for different companies, there can never be a standard multiple to assess business value. Or in other words, the broadly published values of market multiples, what we call the rules of thumb, are really not applicable to every business. Here's an example. Burger King and McDonald's are both well-known fast food brands and seem similar. They have maybe different customer bases, or I should say they have the same customer base of people that want fast food burgers. But they're very different businesses, hence different valuations. McDonald's owns most of the land where its retail outlets are built, which is then leased as a long-term contract to the franchisees. On the other hand, Burger King sells regional licenses to franchise owners and maintains no control over the individual storefront operations and real estate. So each franchisee controls the real estate. So clearly, different types of operations, different value. This chart shows that different industries traditionally are valued differently by buyers. All-time EBITDA multiples remain the highest for the information sector at 11.1, and the mining and oil and gas extraction sector at around 8.2. Meanwhile, the lowest all-time EBITDA multiples are in accommodations and food service at around 2.6, and other service sectors at around 3.1. The median for all industry sectors for all periods is 4.2. But you can see how different industries are valued differently, and it makes sense because they have different intrinsic characteristics. The information sector often has a high degree of recurring revenue, which is highly valued because of its predictability. Accommodations and food service have really suffered because they're not required by business, right? There's this discretionary element to whether you take people out to eat, whether you use hotels, and certainly there's the leisure travel part that compares with the business travel part to make up the entire industry. And there are just too many other factors that make this lower on the investment scale. Manufacturing over here, traditionally above the average, but you'll also see that sort of Low asset businesses like technology, like finance and insurance, are traditionally valued higher than high asset businesses. Company size also matters, and it matters to buyers. In this chart, pricing multiples for private target acquisitions are displayed across 4 different net sales ranges. Each line represents a range of net sales. You can see that larger private companies sell at higher net sales multiples than smaller companies. Note that sales multiples really are imperfect because they do not consider the relative profitability of different companies. This chart's a little bit better. Here's median selling price divided by SDE by size. You can see a little bit of decline in 2022 for companies across all size ranges, but note that the median multiples of selling price per SDE have been consistently higher for each larger size range. That is, the multiples for companies with sales above 10 million have always been higher, so you're 10 million, than companies with sales between 5 and 10, which have been higher than companies with sales between 1 to 5 million, which have been higher than for companies with sales below 1 million. So to sum that up, we have industry differences, we have size differences. Again, another reason why the rules of thumb are really inappropriate measures to kind of get stuck on. Now, I often get asked the question, is value derived from tangible assets? Well, value is multifaceted, right? It does include intangible assets. It does include tangible assets like equipment, but it also includes intangible assets like brand reputation, trademarks, patents, goodwill, copyrights, etc. Because intangible assets give specific rights and privileges to the business, which means they have value. So in assessing the business value, it's necessary to estimate the value of all of its assets. Often these intangible assets are grouped as goodwill, but each is different and well-defined. Intangible assets can also be referred to as the company's secret sauce, something different and special that makes the business unique and prized by its clientele. But since these assets don't have a physical form, agreeing to their value is often the most significant challenge when selling a business. Number 4, valuation only looks at today's numbers. Unless you're selling your business based on its net asset value or book value, the past performance of the company as a standalone data point has limited value. A buyer is not purchasing your company based on what it has done in the past, but on what it can do in the future. Essentially, the viability, stability, and predictability of future cash flows. This is calculated using the discounted cash flow method, where future earnings are projected and discounted based on the theory of the time value of money back to today's present value. For example, if annual inflation is 5%, $105,000 earned 1 year in the future is worth $100,000 today. Since you are selling the future earnings of the business, past performance is only meaningful because it can help predict future results if it identifies a trend that's likely to repeat. So all things being equal, the more consistent your past performance, the easier it will be to predict the future of the company. And the more confidence a buyer has in the projection of future performance, the higher the price he or she will pay for those anticipated future earnings. Valuation amount equals purchase price. In business valuation, the purchase price is the total amount the buyer is willing to pay. A buyer will assess what we call the transferable value of the business, which represents the value he or she will gain from existing operations. Maybe owning the business will be worth more than just an investment. Maybe it will provide a job for the buyer and his or her family members. Maybe the seller is so important to the business that the buyer will offer less if the seller will not stay on post-sale. The business valuation is a baseline figure. It does not guarantee the purchase price. Plus, the purchase price is only one aspect of the transaction, as the deal structure affects the final figures. Several elements have an impact on the deal structure of a typical no cash, no debt middle market transaction, including, is it a stock sale or an asset sale? What's the amount of down payment at closing versus future payments? For example, I sold a staffing business last year that received 90% cash in closing, plus 5% at the 1-year anniversary and 5% at the 2-year anniversary. Are there any seller financing terms? This is very common when you're having a financial buyer that may not have the means to pay full in cash for the business. Sometimes there are requirements for post-transaction clawback provisions to protect the buyer from customer attrition. We see this a lot in the professional services, where the transition from one professional to another takes several years. And it's very important that the buyer have the retention of clients and not see excessive attrition. Short-term working capital needs are another factor that will account for a difference between valuation and purchase price. It's very common for a buyer to set a target working capital amount and then at closing adjust the price of the business up or down based on whether there is more working capital than the target or less working capital on the balance sheet on the closing date. Also, if you're only selling a portion of your business, what's called a minority or a non-controlling interest, there may be a discount applicable to the transaction. Remember, a minority shareholder does not have the same rights as a majority shareholder regarding issues such as business operations, strategy, even setting compensation. Nor can that non-controlling shareholder dictate the amount and timing of distributions from their investment. So their position, it has materially less value than the pro rata share of the total business value. Having low expenses and low debt is not always good. Low expenses and debt may mean you're not reinvesting enough in your business, leading to a stagnation in value. When you reinvest in your business, you do it to increase revenue and profit, or to add new business locations or product and service expansion. Reinvesting also means upgrading your business by improving operations or updating your operating systems. These improvements will contribute a lot toward a better valuation. Outdated technology or machinery that might need upgrades after the sale naturally reduce the acquisition price. This is no different than trying to sell a house that will need a new roof in a few years. For example, I worked on a buy-side project where our due diligence found outdated technology with the seller that would require an expensive upgrade. So this cost was adjusted to the original offer and reduced our original offer. I also often see tax returns that show little business income. This may be good for tax planning, but it backfires for exit value planning. The buyer wants a business where they can see robust cash flow, not one where all the evidence shows that it's only breaking even. When asked how much something is worth, many people answer that the fair market value is whatever someone will pay for it. Even though there's no precise value for a given business, we do not subscribe to the premise that, as in the work of art, as in the case of a work of art, that value is completely subjective. Companies do have an intrinsic value based on the future economic benefits that they can provide. So for us, value is not all relative, just partly relative. Now, as we already discussed, the value of the business will vary greatly from one buyer to another based on their individual expectations of future performance and their assessment of the risks associated with those expectations. but a buyer will expect to receive their initial investment back within a reasonable return over a fairly short time frame. Another issue in this sort of relative versus absolute assessment of value is whether a seller's accumulated goodwill is transferable to the buyer. If that goodwill is personal, like customer relationships or owner prominence in the community, that value may not all transfer to a buyer. As an owner, your sweat equity and emotional attachment to the business, that baby you founded and nurtured to success, may not hold the same value for your acquirer. The key to making this intangible goodwill saleable is to institutionalize it, so it becomes goodwill of the entity, not the individual. In other words, clients need to become customers of the business, not of a specific salesperson. Process knowledge needs to be shared and documented so the business flourishes without the owner. So if I can sum this all up, the goal of a seller should be to maximize the transferable value of the business. Let's look at some private company transactions by buyer-seller type. As I mentioned earlier, the characteristics of the buyer will influence the size of the offer. Transactions between private buyers and private sellers, which is the blue line down here, are consistent at around 0.5 times net sales. While private company sales to public company buyers, the gray line here, are drawing much higher multiples. Why? Well, public buyers of private companies have historically paid the highest multiples, and we're going to look into why. In this slide, we see median selling price over EBITDA by buyer-seller price. Transactions between private buyers and private sellers, blue line again, which are most of the middle market transactions, are completed at less than 5 times EBITDA, whereas public buyers of private sellers have historically offered between 10 to 20 times EBITDA. So when you hear that a company is sold at 15 times EBITDA, the first question is, who was the buyer and who was the seller, right? If it was a public company buyer, that could make sense. If it was a private company buyer, that's quite an outlier. Why are public buyers and public sellers transacting at higher EBITDA multiples? Well, the primary reasons are access to capital and liquidity. Public buyers are more likely to have significant cash reserves, or they can efficiently sell equity so they can acquire a business without the high cost of debt. Right? If you're a private company and have to take out a loan, and if prime is 8% and the SBA is adding fees of 2.5 on top of that, you've got a 10.5% loan that you now have to build into your cash flow model post-acquisition. Whereas if you're a public company buyer and have sufficient capital reserves, you don't have the same expense. And lastly, I get the question, are all businesses saleable? And unfortunately, there are some businesses that are not saleable, simply because they're less expensive to start from scratch. In these cases, there's no real benefit to acquiring an existing company. And there are other businesses that operate for a long time without ever paying the owner a return on his or her investment. Sure, the company has hopefully paid the owner a salary, but unless that salary and other benefits exceed the market value salary for what the owner is doing on a day-to-day basis, the owner may just be creating his or her own job. If you own a business and work in it, you're entitled to both a reasonable salary for the work you perform as an employee and a reasonable return on your investment as owner. You probably expected to make a fair return on your business. But if it has not happened for you, why would someone else make the same investment? When you think of it in this way, it's easy to see that not all businesses are saleable. I hope you got something out of the first two sections of our program. Um, the next thing I want to talk about are what are the common methods used in performing business valuations. There are really three methodologies: the income method, the market method, and the asset method. And they're really independent. The income approach is directly related to the present value of future cash flows that the business is reasonably expected to produce. It has nothing to do with historical transactions or market multiples. It does require estimates of future cash flows and an appropriate rate to discount those future cash flows. So the past performance as a predictor of future cash flows is very important. The buyer's test method is another income-based method where we look at the transaction from the buyer's perspective. Can the buyer spend X amount and receive a return of Y plus their compensation? And can all of that achieve a target compensation plus investment return after paying the debt service that makes it worthwhile for them to go through the acquisition? The market approach, we talked about comparable transactions already, but we use this method to determine the value of a business by considering the market price of businesses that have been historically sold or those that are still available. In the comparable companies method, we use guideline public companies because they're actively communicating the value of the business by their shareholders who are trading shares every single day. Every day you can go into the Wall Street Journal and see what businesses, what the share price is, and through some calculations determine what shareholders are deciding the market value of that business is. And the asset approach is a valuation method that focuses on the value of the company's assets. The assets are evaluated, liabilities are deducted, and the fair market value is obtained. It does not take into consideration the value of intangibles or goodwill. It's independent of the future cash flows, like the income method, and it's independent of historical transactions, like the market method. And so what we're going to do right now is focus on the three most commonly used methods: the comparable transactions, comparable companies, and the discounted cash flow. Here's an example of data from one of our sources that addresses the comparable transactions. So these values come from M&A transactions that have been reported by brokers and lenders to this database company. A couple considerations. Notice how the different multiples that we see here are reflective of different sizes companies. In this particular data extract, you can't see the geographic differences, but they're important. Companies, let's say in Metro New York City, may sell differently than a company in Sioux Falls, Idaho, yet they may be in the same business. So there are a few drawbacks to using this method. No two companies are identical, so we have to look at the geography, we have to look at their profitability level. You can see here that in these 5 examples of the brewery, each one has a different profitability level. That's their SDE percentage. And so obviously they have a different price to SDE multiple. Also have to be, I guess, cognizant of the accuracy of the information, since it's all coming from private transaction sources. Here's an example of the comparable companies analysis, where we have, in this case, branded packaged goods is the industry, a number of publicly traded companies. And so we can see the financial data and calculate the pricing multiples which are here. So here's the total enterprise value divided by the last 12 months revenue and EBITDA numbers for all these different businesses in the same industry. And down here we have sort of that median value. But I want you to see that of this median of 13.2x of total enterprise value to EBITDA, there's a wide range. And this is important to understand that in any of these analyses, there are a spectrum of transactions. And when you look at a median, obviously, half of those transactions are going to take place at above the median value, and half are going to be below the median value. So we know we really can't focus on the median value alone as a measure. Here's an example of a chart that we use to help develop the qualitative assessment of a business. And this part of the process is key because it differentiates the subject company from the published market averages. The quantitative modifiers compare our subject company's key performance indicators to industry averages, where we're assessing comparative liquidity, profitability, financial efficiency, and leverage ratios. Then we use qualitative factors, which we value and we weight them to show their impact on modifying the market multiples. Reported historical multiples, as I said before, are mean values from many transactions. But should your business be valued at the mean? Or maybe it deserves a premium or discount to the mean because of factors like profitability, location, owner engagement, or other factors. Slider here. Now let's talk about the valuation process. The first step in the valuation process is the financial analysis, calculation of SDE and EBITDA, making the appropriate adjustments. And we typically look for 3 to 5 years of historical financial transactions. Second step is interviewing the client to learn the qualitative factors that would influence the value, right? Move that subject company off of the mean and determine realistic projections and the risks of the business. Next, we're going to look at market research, identify comparable company and historical company transactions. Then we're going to determine which of the valuation methodologies best fit the situation. What weights should be applied to each methodology? We're going to consider the qualitative adjustments that we just talked about. And then we're going to put the puzzle pieces together and reconcile the data to arrive at an implied valuation conclusion. After each valuation methodology is considered and calculated and the subject company is analyzed for qualitative value drivers, we're going to put all the puzzle pieces together to arrive at what's called an implied valuation range. The implied value is obtained after considering the appropriate weight we would apply to one method versus another. We then display them in what's commonly called the football field, because the bars look like yard lines on an actual football field. And this is for an actual client. So what you can see here are that multiple valuation methods have been used. What you can't see is the weighting that's been applied to each. But we are plotting the high, low, and median value with each method. And the implied value is a result of the weighting of these different methods. In this example, the public company revenue and the public company EBITDA were weighted low, and the adjusted private company comparables in these columns here were weighted higher. And what I'd like to finish up with today, hopefully now that you understand the valuation process, are how you as a business owner or operator can influence the value of your business. And we believe this can be done by addressing the value drivers in your business, the factors that you can manage. And here are the 8 key drivers that we focus on. First, financial performance. We advise that you migrate from minimizing taxes to showing a profit. R2R stands for record to report. Your record to report cycle should be prompt and thorough. You should be able to produce your financial statements promptly after a monthly and quarterly close. Your budgets should integrate financial budgets, cash budgets, and capital budgets. And you should introduce segmented reporting if divisions have different characteristics. For example, a brew pub is both part restaurant and part production brewery. Different characteristics, different profitability models should be reported. Both segments should reporting, and you as a business owner should evaluate them individually, because you may lose information if you're only looking at the total business picture. Growth potential. What is your production capacity? Not what is it now, but do you have the ability to grow and respond to demand? Do you have access to capital and access to debt? You know how much capital will be required to increase your capacity. You have a debt facility in place, like a working capital line of credit. Are future investors being cultivated who you could tap into for future equity? The Switzerland structure is another important one, because operational dependence has risks that imply value discounts. Are you dependent on any key employees where their departure would seriously devalue your business? You have concentration in only a few customers, right? A business that has 50% of sales in 2 customers would be worth less than a business that has 50% of sales aggregated among 10 customers. Same thing goes with supplier concentration. Separate, a little bit of a different look than just financial performance is your cash flow. How do you sit on the seesaw? Are you a cash faucet or a cash drain? Your cash flow should be sustainable and forecastable, right? Predictable. It's important that you manage the OTC, or the order to cash cycle, and the P2P, your procure to pay cycle. You want to be able to ensure that you are able to convert orders into cash promptly, and that you manage your procurement and your payment cycle in a way that supports your incoming cash flow. Another key driver is recurring revenue. This is very important. But technology companies are often evaluated on the annual recurring revenue, or an ARR measure, where it's even more important than the net income. We're going to talk about this in more detail on the next slide because it's so important. But this is the reason why contract staffing firms that have recurring and predictable revenue are valued higher than perm placement staffing firms. Even though the perm placement is generally more profitable, there's a limited ability to predict your future cash flow. And buyers are valuing that predictability over the higher profitability. Monopoly control. If you sell in the retail world, do you know your competition? Do you know your competition within 15 miles that you're competing with? If you're more in a B2B and wholesale operations, do you know your market position? Are you able to create a moat around your business so that there are high barriers to entry. Hub and spoke gets back to the owner involvement I spoke about a little bit earlier. If the owner is in that hub and all decisions have to be approved by the hub, and if the machine breaks, only the owner knows how to turn it on, um, that's going to be a challenging business to sell because so much of the value is tied up in the owner and not transferable to a buyer. The more you as an owner can extricate yourself from the day-to-day management, uh, very, very important. And the customer score, hopefully you're familiar with like the net promoter score. Um, Want to make, depending on whether, again, you're a retail or a B2B business, uh, are you creating seasonal changes to entice return business? We see this a lot in the food, beverage, hospitality. Are you proactive on social media? In the wholesale world, are you matching your service level to match your sales level? Where your um, most profitable and largest customers are getting the top level of support. And here's where I want to drill down on recurring revenue, because it's really one of the most important value drivers for a business. And I like you to think of it as really a 6-level hierarchy, as rungs on a ladder. We really want to climb to the top for the most value. So at the low level, but still valuable, are selling consumables. Think of toothpaste, right? Repeat purchases by customers are necessary. But on the downside, there's no requirement for brand loyalty, right? You can use Crest one month, you can use Colgate another month. You're still getting that value of having to replace the consumable, but it's not as strong as the next level, which is a sunk money consumable. Think of razor blades and razors, right? The customer first invests in a platform, in this case, a razor, and so now they're bound to your brand of consumables, meaning the razor blades, because only your razor blades fit in your razor. Next level up is what we call renewable subscriptions, like magazines. They get paid in advance. There's no collection issue. So it's a great model for recurring revenue. A little bit better are what we call sunk money renewable subscriptions. Think of like the Bloomberg investment terminal. Financial advisors will buy the terminal, and because they've sunk money into it, they now have to subscribe to a data plan in order to use the terminal, right? We see that in computers now. It used to be that you bought Microsoft Office, one-time fee, and now to use Microsoft Office, it's now called Microsoft 365, you have to pay an annual subscription, but you've already invested in the computer, you've already invested in learning the software, right? Once you start using Word and Excel, you're not going to stop using Word and Excel. Number 5 on the ladder is automatic renewal subscriptions. Think of like document storage, right? Many businesses will send their documents to like an Iron Mountain or some other place and pay an annual fee until you decide to stop. And the last and highest value model of recurring revenue are contracts. Think of the wireless phone model, where now they give away the phone for free for a 2-year contract. They've got you locked up. You're probably paying on a monthly basis. And then when your contract is up, they've got a new offer, again, to bind you to this commitment. And why is it valuable? Because we discussed before, having predictable future cash flows will increase the value of your business. Here are a few other additional risks affecting value. Important to be aware of them. The tenure and turnover of your talent, your cybersecurity vulnerability. I'm not going to read them all, but these are all factors that a professional valuation analyst considers in valuing your business. So which business is worth more? In this example, both A and B are 5 years old with 10 million of revenue. B is more profitable with a 15% net SDA margin. However, A has more recurring revenue. B has the advantage where the owner is not engaged with customers. And yet A is highly concentrated and B is less concentrated. It's really impossible to tell at a summary level which business is more important than the other, because there are many value drivers to be considered to determine their relative importance. Also, what's most important for the purpose of valuing a business for an acquisition is that it's not just about the numbers, but about what's behind the numbers and what buyers are looking for in a target acquisition. So I hope you can see that there are many factors influencing a business value, which is why we believe a professional valuation is the only way to compute a company's true value. We like to say valuation is as much art as it is science. And our experience has shown that business owners who focus on driving value are actually different than typical business owners. I meet many owners who fit the left side description. Their financial statements show few cash reserves because they take it all as compensation or distribution. And I can't even get financial statements promptly. Their time horizon is about sales and profit in the current month, not in building a company for future wealth. They don't invest in creating extraordinary tools so everyone in the company can perform at a high level and the owner doesn't have to drive the business every day. And they say they don't have time to focus on plans and strategy because they're stuck in day-to-day management. Those owners who can become value builders see higher market multiples when they sell. And this is why we at Stony Hill have embraced the value builder system to help our clients reach their maximum value. As an offer for today's attendees, we're offering a complimentary value builder self-assessment, and you see a registration link in the PDF of this presentation that was sent to each attendee. The Value Builder questionnaire includes 32 questions categorized into each of the 8 themes or drivers of the company's value. So it doesn't take that long to complete. But here's where it gets interesting. After analyzing over 50,000 businesses who have taken this assessment, the average Value Builder score is 59 out of a possible 100. Now that's on an absolute basis. When you get your report, you'll get your score on an absolute basis and also compare to companies in your industry. But for those companies who have taken the Value Builder assessment, the acquisition offers that those that are in that average range, the valuation multiples that they receive are about 3.5 times pre-tax profit, which is kind of in the lower range that we saw in a couple of those other slides where it showed really historically between 3.5 and 5x is where privately held businesses trade when they're being bought by other privately held businesses or entrepreneurs. However, the Value Builder users who've improved their score to 90 or greater have received offers of 7.1 times pre-tax profits, so nearly twice as much. And it's not because they're bigger or because they're more profitable. It's really because they've been able to address all those risks that, when mitigated, improve the value. So I hope that many of you will take this complimentary assessment and review its findings. because in our experience, they proved to be extremely valuable. All right, well, I want to thank you for attending today's webinar, and look forward to hopefully speaking with many of you in the future. Thank you so much for participating. Don't hesitate to reach out by phone or email if you have any further questions. Thank you again. Bye-bye.